In this video, we'll break down the 6 most popular Australian share ETFs on the ASX. Let's dive straight in. Number 1. VAS, Vanguard Australian Shares Index ETF. VAS is Australia's largest and most traded ETF, with over 20 billion of asset under management as of July 2025. It was first listed in May 2009 by Vanguard, one of the most reputable fund managers globally. VAS tracks the S&P ASX 300 index, which covers the top 300 companies on the ASX by market capitalization. This means it provides exposure across large cap, mid cap, and small cap Australian companies. To understand the scale, there are currently approximately 1,950 companies listed on the ASX, and VAS invests in the largest 300 based on their size. But because the ASX is heavily weighted towards its largest companies, these 300 companies, just 15% of the total, make up around 82% of the entire Australian share market's value. So by investing in VAS, you are conveniently capturing the performance of more than 4/5 of the entire Australian share market. However, focusing on the top 300 companies by market cap is a double-edged sword, as it inherently amplifies the concentration risk that already exists in the ASX and the Australian economy. The top 10 holdings make up 46.46% of the VAS portfolio, while the top 2 sectors, financials and materials, account for 51.87% of the entire fund. The technology sector, often seen as the engine of global growth and the backbone of the future economy, makes up less than 4% of the portfolio. As of June 2025, VAS has an incredibly low annual management fee of just 0.07%. Here is VAS performance at the end of May 2025. The difference between the total and gross return is a management fee. Since VAS is a passive index ETF, there is very little scope to outperform the benchmark. As expected, the gross return closely tracks the benchmark. If we break down VAS total return, it consists of 2 key components. The gross return, which reflects the price appreciation of the ETF units, and the income return, which represents the dividend distributions over the past 12 months as a percentage of the ETF's net asset value. VAS pays distribution quarterly and typically delivers a cash yield of around 4 to 5%. When factoring franking credits, the grossed up yield can increase to approximately 5 to 6% per annum. Overall, VAS is a strong choice for Australian investors looking to build the core of their portfolio with broad exposure to the Australian share market. Next, we have A200, Better Shares Australian 200 ETF, IOZ, iShares Core SP ASX 200 ETF, STW, Spider SP ASX 200 Fund. I'll cover these 3 together as they are very similar in many ways. First, they are all managed by well-established and reputable ETF providers. Better Shares, a homegrown Australian ETF manager, founded in 2009 and has quickly become one of the leading ETF issuers in Australia. BlackRock, the world's largest asset manager. State Street Global Advisors, one of the original pioneers of ETFs, having launched the world's first ETF in 1993. As of June 2025, these 3 ETFs manage substantial assets, providing deep liquidity for investors and the scale needed to support their ultra-low fees. By the way, I'm using Moomoo's compare feature to bring all this valuable information into one clear and organized view. Once you have created a Moomoo account, just search for the ETF you are interested in. Tap the 3 dots and hit compare. From there, you can keep adding up to 6 ETFs side by side. All 3 ETFs passively track indexes that cover the top 200 Australian companies by market capitalization, so they have nearly identical holdings, sector allocation, and performance. They all pay distribution quarterly. Although they have slightly different cutoff days or ex-dividend timings, which can affect how the trailing 12 months dividend yield is calculated, Over time, all three should produce similar dividend yields. For most investors, they are functionally interchangeable. Compared to VAS, which tracks the broader ASX 300, these three ETFs invest in the top 200 Australian companies by market capitalization. That means they exclude the next 100 mid and small cap companies, many of which are still growing or emerging. In theory, this results in slightly lower volatility and less exposure to high growth opportunities. However, it's worth noting that the difference is relatively minor. The actual 100 companies in the ASX 300 make up less than 3% of the total Australian equity market. So the performance of ASX 200 and ASX 300 ETFs tends to be very similar over time. One brilliant feature of Moomoo is the ability to capture your entire comparison in a single snapshot and save it as an image. No need to take multiple screenshots of each section. You can also easily share your research across social media or messaging apps, making it super simple to pass on your insights. Moomoo is test sponsored for ASX securities and charges just $3 brokerage for trades under $10,000. On top of that, they are offering generous sign-up bonuses. Adding the powerful comparison feature I just showed you, it's hard not to love. Use the link below to sign up and make the most of these perks. If you like this video so far, don't forget to like and subscribe. And please bear in mind, this video is for educational purposes only and not financial advice. Always do your own research or speak to a licensed financial advisor before making any investment decisions. Next, we have MVW, the VAS Australian Equal Weight ETF. As of June 2025, it has approximately 2.85 billion Australian dollars in assets under management. This ETF is different from the others we have talked about. Instead of picking companies based on their size and giving more weight to the biggest ones, it uses an equal weighting approach, which means each company in the portfolio is given the same weight, no matter how big or small. It passively tracks the MVIS Australia Equal Weight Gross Return AUD Index, which undergoes rebalancing on a quarterly basis, specifically in March, June, September, and December. MVW currently holds 72 companies, generally selected from the top 100 to 120 ASX-listed stocks based on size and liquidity. During each rebalance, the index resets the weight of each company to an equal weight of approximately 1.39% of the portfolio. When you look at its top 10 holdings, they are noticeably different from those in A200, IOZ, STW, or VAS. What you are seeing is essentially the stocks that have performed well since the last rebalance. Unlike market cap weighted ETFs, MVW reduces the concentration risk that's common in the ASX and gives more weight to smaller, larger cap and mid cap companies. It also results in more balanced sector exposure. So instead of being heavily tilted towards banks and miners like many other Australian shares ETFs, MVW spreads its weight more evenly across sectors such as healthcare, technology, and industrials. Additionally, the quarterly rebalancing enforces a building buy low, sell high discipline by selling winners and buying underperformers to maintain equal weighting. When comparing performance, MVW has shown a noticeable edge during periods when the broader market is recovering and most companies are rising. During such times, smaller and less dominant companies tend to outperform large caps. However, it can lag behind when market gains are driven primarily by a few heavyweight stocks dominating the index. MVW has a management fee of 0.35%, not ultra low but still reasonably competitive. MVW pays distributions twice a year. Its income return is quite competitive, typically in the low 4% range, but it may be slightly lower than the other four ETFs during periods when big dividend payers such as banks drive most of the ASX income yield. Overall, it's a compelling option for investors seeking greater diversification and less concentration in the largest ASX stocks. Last but not least, we have VHY, Vanguard Australian Shares High Yield ETF. It has a low management fee of 0.25% and large asset under management for deep liquidity. This is an ETF that stands out for its income focus. It tracks FTSE Australian High Dividend Yield Index, which selects companies based on analyst forecast dividend yields, aiming to include those expected to deliver sustainable, above-average dividends backed by solid fundamentals. It currently holds 67 stocks, weighted by market capitalization. Security diversification is achieved by restricting the proportion invested in any one industry to 40% of the total ETF and 10% in any one company. Australian real estate investment trusts are excluded from the index. VHY has a strong bias towards banks, telcos, and energy stocks, driven by its focus on high dividend yields. Financials and basic materials together make up over 60% of the portfolio, and the top 10 holdings account for around 65%. This gives VHY arguably the highest concentration risk among all the ETFs we have covered. VHY pays distribution quarterly, and thanks to its income-focused strategy, it typically delivers a higher income return than the other ETFs we have discussed. Over recent years, its yield has hovered around 6 to 7%, and in the 12 months to 31st of May 2025, it has reached an impressive 8.37%. And that was just a cash dividend yield. If franking credits are included, the gross up yield would be higher, typically adding an extra 1 to 1.5%, depending on how much of the income was franked. Overall, VHY is an excellent option for investors who prioritize higher dividend returns, especially retirees or income-focused portfolios. Each of these 6 ETFs takes a slightly different approach in terms of focus, diversification, and strategy. They can form a strong core for gaining exposure to the Australian equity market. That said, it's important to do your own research and consider whether additional investments, such as international equities, could complement your portfolio. And if you're looking to refine your investing setup, be sure to check out my video on the 5 best online brokers for Australians in 2025. Thanks for watching. I'll see you over there.